Buying options is a strategy in investing that can allow you to massively increase your returns. But if you're not careful, it could be quite ugly. In this video, I'm going to talk about buying options on Fidelity, some of the different things that you need to know, and some different strategies you can incorporate. When you are buying an option on Fidelity, whether it be a call or a put, you are buying it to open. If you want to close it, you select sell to close. If the option expires in the money, Fidelity will exercise that option for you. Or if you don't have the sufficient funds, it will expire. So make sure that if you don't have the funds and you don't plan on exercising the option, make sure you trade it before the expiration. So a few different things to note when it comes to buying options. It is a time-sensitive form of leverage, where pretty much you get the right, you say, I want to buy 100 shares at this price in the case of a call, or I want to sell 100 shares at a certain price in the case of a put. If you buy a call, you are bullish. If you buy a put, you are bearish. And you could do this for indexes, or you could do this for individual stocks, entirely up to you. So a few different things to note when it comes to calls and puts. You're going to have the most movement during earnings. So if you are selling these options and maybe you don't want to sell your shares in the case of a covered call, or you don't want to get them at a really low price in the case of a cash secured put, you might want to stay away from selling the options. But in the case of buying options, if you want to get the most bang for your buck, you would buy at around earnings season. Now, the risk is that if the earnings don't go your way, the option is going to dramatically drop in value because now there's no earnings catalyst to potentially pop the stock higher. So part of the thing about earnings is that people know that an earnings report could really propel a stock like 5% up, 10% up, or do the opposite. So if that factor is now all of a sudden taken out of play, there's not as much volatility in the stock, and premiums will go down, which means the value of the option will go down. So that's why, unsurprisingly, options for a stock like Tesla have higher premiums than options for a stock like AT&T, because Tesla is far more volatile than a stock like AT&T. When you are getting started in options, make sure you pick the lower priced stocks, because that gives you more opportunity to experiment. And if you lose, it's not a big loss. So I would stay away from options of stocks like Amazon, just because you have to pay thousands of dollars just to buy a single contract. And I'd rather have a contract that I pay a few $100s for, not go my way, versus one that I pay a few $1,000s for. So make sure you are picking stocks that are a little bit more affordable with the premiums on those contracts. A great strategy you could use for buying options is to buy what's called a leap option. A leap option is you buy a call that expires more than a year out, and you pick a deep in the money call. This allows you to essentially buy into a stock at a lower price. So let's say that you are very bullish on a stock that's currently priced at $100, but you're like, I don't have enough money to buy 100 shares. You can buy a call option for that stock that has a strike price of, let's say, $70. And then instead of paying the $10,000 to get the 100 shares, you're only paying something like $4,000 to get the movement of those 100 shares. So people will use this strategy because it is a form of leverage. And if the stock increases in value, the contract is going to increase at a faster pace, and you didn't need to pay as much money to enter into a position. That gives you the rights of, like, what you feel like doing with 100 shares versus if you saved up all the money to buy 100 shares. If the stock goes down, the option will go down quicker. But since you are buying this option with a year of expiration, you have more time for the thesis to play out. One of the things about short-term options trading, if you do weekly option trading all the time, which there is a time for that, but then there's a time not for that. Like, just because you have the ability to buy options doesn't mean you should be buying them every single week. But if the stock goes up for no good reason, you have less time for your thesis to hold, which means the option is going to rapidly deteriorate in value. buying the further out options costs more money. It does give you more time for things to play out the way you want them to play out. Sometimes it makes sense to sell options at a loss because it's better to lose some of your investment than to lose all of your investment, which is entirely possible with options trading. Because if you buy a call at a set strike price and the stock never reaches that strike price and always stays below the call price, then that's going to eventually expire worthless. It's better to collect whatever you can rather than watch it go down to zero. This is why you shouldn't put too much of your money into options. I like to do anywhere from 0.5% to, when I'm feeling really aggressive, 2% of my portfolio into options because I understand the risks. I also understand the rewards. You gotta have like a 1% position in options that doubles the gains you make in that day. So let's say you make $300 in one day. The option can do really well and add the other 300, especially if you do this right before earnings, where the earnings going significantly your way can turn that small segment of your portfolio committed to buying options into the big winner for that day that possibly, even if this is 0.5% or 1%, possibly gives you more gains than the rest of your portfolio. That's how powerful options are. But then you see stuff like Wall Street bets and YOLOs. That is a very dangerous way to invest in options. Do not do that. Some of those people, like they put all their money into a single contract or maybe a few contracts. You would get very rich very quickly, or you could end up broke. And it doesn't matter how much money you have in your portfolio, whether it's $100,000 turning into $800 or $800 turning into $100,000. Both of those scenarios are possible and have more than likely happened through Wall Street bets, YOLO type of speculative investing. Another option strategy you can use is hedging. So let's say you have 100 shares of a company and you don't want to sell the shares because you're a long-term holder, but you think that there's going to be some downward motion ahead. Maybe you're afraid of a bad earnings report. Instead of selling the 100 shares and panicking, you could buy a single put. And the put will basically compensate for if the shares go down. So if the shares decrease, the value of a put increases. And I've done this a few times for some of my stocks like Fastly, which I'm a long-term holder of that, but I have bought puts which have shielded me from a good amount of the losses that Fastly has had in the recent weeks. So sometimes you don't want to sell, but you feel like, something bad's going to happen. You buy a put to protect yourself. And then rather than exercising the puts and selling the shares, you would instead trade the put. You would sell to close the position, and then you would have all those gains to compensate for losses. If you short a stock, you should definitely buy a call because that will protect you if the stock has dramatic upside. Hedging is a really great way to protect yourself from some of the losses that can come your way. So those are just some of the different strategies for buying calls and puts. Don't do this for a ton of your portfolio. The year out one, though, the leap, that is one where if you are bullish on a stock, that will naturally be more of your portfolio. But at the same time, you have more time for your thesis to play out. So in any event, I hope you guys enjoyed this video about buying options. Let me know if you guys buy options, if you're thinking about it. Always love to hear from you guys in the comments. Make sure you subscribe for more like this, and I'll see you guys next time.